Hi, it's Mel Dennis from Domain & Co here for our professional property series. I'm sitting with Kev from Acknowledge Accounting. Thanks for joining us, Kev.
Not a problem. Thanks for having us.
Today we thought we'd have a chat around appreciating assets and capital gains tax, your CGT. Kev.
Yes, spot on. So when people sell a property, they often forget that they need to pay some capital gains tax on that property.
And that can be a bit of a hit at the end if they're not ready for it.
Definitely. Most people have already planned what they're doing with the proceeds and haven't thought about the tax consequences. So look, when you sell your main residence, there's obviously some clear main residence tax exemptions where you don't have to pay capital gains tax. They're quite complex, the rules around that, so we won't cover that off today.
No, but it could be things like if you've made any deductions for your home from renting out a room, possibly leasing your business.
Correct.
Rooms from your business through your home.
That's right. So that's where some of the complexities arise. Other things as to whether you first moved into the home or whether you first rented it will have different outcomes on the capital gains tax consequences. However, for investment properties, it's really important to know how to calculate a capital gain and what your tax liability may be. So to calculate a capital gain, you need to work out what your initial cost base was of that property. So what you paid for it, plus some stamp duty, legals, things like property advocacy costs, any holding costs before the property was actually rented. That forms part of your cost base. To calculate the capital gain, you then have to work out what did you sell the property for. So what are the proceeds? Take off your commission that you've paid and any other legal costs that you might have incurred to sell the property. So you've then got your net proceeds, subtract from that our net cost base, and that works out your capital gain. There are a few other little adjustments to the capital gain that we will need to consider. Things like capital works deductions. So if you've been claiming capital works deductions, which are the equivalent of 2.5% of the structural value of your property throughout the life of that investment property, then we need to make sure, yes, claim it throughout those years on your income tax returns, but when you dispose of it, there is actually an adjustment to the return whereby you will need to pay or repay some of the tax that you've claimed on that, okay?
Still better off to do it as you go through the year though. You are better off with the money in your pocket at
Definitely. And it's really important. So by claiming that throughout the life of the investment property, you're getting the tax dollars in your hand or in your pocket at that time. When you dispose of it, yes, there is an adjustment, but the way the capital gains tax discounting works, if you own a property for more than 12 months, you get a discount or capital gains tax discount of 50%, which means that you don't pay capital gains tax on, let's say you make $1 million capital gain, you only pay the capital gains tax on $500,000. So when we adjust for this capital works deduction, you're still at least 50% better off of the value that we've claimed. So that's really important. And the other thing to consider too is when calculating your capital gain when you dispose or transfer the property, it's important to note that you first offset any of your losses that you've made on previous investments. So if you've got capital losses from prior real estate investments or shares, you must first offset those.
Yeah, good. So that can be handy if you have had some losses in other areas.
Yeah, sure.
So Kev's kindly offered to put together an Excel formulated cheat sheet, I suppose, to help you work out your capital gains. You can also obviously chat with him directly if you're looking for some accounting advice, and he'll be able to help you on an individual basis with it as well, or chat with your accountant to make sure that you know how much money you're going to have in your pocket at the end of your sale and settlement process before you race off and spend that money. But thanks again today, Kev, for joining us. We really appreciate it, and we hope we've helped you out with some information around capital gains tax. Thank you for watching another one of my professional property series interviews. I'd love to see your comments, and please like and subscribe to my social channels on Facebook and YouTube. I welcome any suggestions for new topics too.